The Japanese yen is facing a challenging start to the week, trading in the red against a range of currencies. This move comes despite mounting pressure from the U.S. government on the Bank of Japan to raise interest rates. A tale of two currencies, yen's plight and dollar's rise. The yen's decline against the U.S. dollar is a notable development, especially as it retreats from a 3-week high. This shift is significant because it indicates a potential change in the Japanese government's stance on monetary policy, which has so far resisted U.S. calls for rate hikes. Market expectations and the path forward. Markets are now closely watching for further signals to determine the likelihood of a rate hike by the Bank of Japan in September. Currently, there's a 40% probability priced into the market, but investors are eager for more data on inflation, unemployment, and wages to reassess these odds. Inflation and interest rates, a delicate balance. The latest inflation data from the U.S. is a key factor in this equation. While the Consumer Price Index remains steady at 2.7% in July, core inflation, excluding food and energy prices, rose to 3.1%, exceeding expectations. This data has prompted investors to increase their expectations of interest rate cuts by the Federal Reserve in September, October, and December. A controversial move? But here's where it gets controversial. Should the Bank of Japan raise interest rates in response to U.S. pressure, or should it maintain its current policy to support economic growth and avoid potential negative impacts on the Japanese economy? What do you think? Share your thoughts in the comments.